Okay, well, to kick off our afternoon session, we're going to hear a little bit about natural gas issues and emerging trends for this winter. We have as our presenter this afternoon, Kevin Petak, who's Vice President of Gas Market Modeling for ICF International. He's certainly been a speaker at our winter fuels conferences in the past, and he has 26 years of experience in the energy industry. He's directed numerous energy market studies and looking at the analysis and impacts of gas production, storage, liquefied natural gas, and so forth. And with that, I'll turn it over to Kevin. Thanks.
Thank you. Delighted to be here to talk with you about North American natural gas markets this afternoon. I thank Nazio for inviting me to present, and hopefully I'll be pretty enlightening with this presentation. I noticed whenever I was looking at the presentation after I put together that I was remiss in not including a disclaimer slide. Basically, that disclaimer would essentially say something like, don't trust anything I say. If you trust it, do so at your own risk. I usually like to say whenever I start these presentations that inevitably with the forward-looking statements that I'm going to be making, that I'm going to be incorrect, because no one could hope to get all the assumptions about the marketplace right in the future. But hopefully I will be enlightening with what I have to say. So with that, let's go ahead and get started. What I'll do is I'll set the stage, first of all, by talking about recent trends in North American natural gas markets and what we're seeing, some of the important nuggets that we're seeing in the recent trends and what that portends going forward. And then I'll talk about our near-term outlook and talk about the longer-term outlook as well. So with that, let me start first with drilling activity. And it's kind of interesting in production, and I was not here for Adam Szyminski's presentation this morning, but I suspect he also talked to this, to recent production trends, particularly since EIA now has a new product out, the which is a productivity report. And interestingly, whenever you look at recent production trends, what you notice is that gas-directed drilling activity has dropped off pretty significantly over the past couple years. And it's been at a relatively low level here over the last year. Essentially, we've had about 400 rigs drilling for natural gas in the US. Now, on the flip side, oil-directed drilling activity has risen pretty significantly over the past couple years. And as we look up here, we see that there's roughly, 3/4 of the rig fleet that is essentially drilling oil wells. And that should come as no surprise, because essentially as we look at oil prices versus gas prices, we see $90, $100 per barrel oil prices, and we see $4 per mm or $3.50 per MMBTU gas prices at Henry Hub. Simple rule of thumb, to convert oil prices to dollars per MMBTU, generally take the dollar per barrel value and divide it by a factor of 6. So if you have $100 oil prices, you essentially have $16 per MMBTU oil prices. So that explains by and large the rig activity change and why we've seen the fleet shift over the past 12 to 24 months away from gas activity to oil activity. But that doesn't tell the full story. Essentially, the rigs that are drilling for natural gas are becoming much more efficient. The drilling time for drilling a gas well has essentially been cut in half in some areas over the past 3 years. So basically, producers are doing more with less. Essentially, yes, there's less rigs drilling for gas, but there's also more wells per rig produced or put online per year. As well, the productivity increases for natural gas have been rather dramatic. Essentially, if you look at the Marcellus Shale, for instance, the EURs per well, estimated ultimate recovery per well values, have essentially gone up by a good 60 to 70% over the past 3 years. That's a pretty dramatic increase, essentially from about a 3 billion cubic foot per well value to a 5 billion cubic foot per well value. So the bottom line of all these trends is that producers are essentially doing more with less. They're becoming more efficient. There's continued technology improvements, and that is in fact what has led to the fact that natural gas production has still continued to grow. Whenever we look at it, even though there's less wells being completed, they're more productive, and thus natural gas production continues to grow. And that's the chart here on the bottom right-hand side. Now, albeit production has grown at a much slower pace over the past 6 to 12 months. And that in part is because of the fact that the rig decline, the rig activity decline, has overwhelmed the productivity decline, but nevertheless the productivity increase, but nevertheless that increase has still resulted in a growing production. Now, another way to look at the market and think about what's happened over the past couple years is to look at gas balance tables like I show here. And there's a lot of numbers, a lot of detail here, and it's a little bit difficult to comprehend. I get lost in all the numbers myself sometime, and I'm an analyst that looks at numbers daily. So I'd like to draw to your attention a few different numbers that I see up here. And one that's very interesting is that gas-fired power generation, or the amount of gas used in power generation over the past year, has gone down relative to the 2012 level, and actually down pretty significantly. And why is that? Well, it's not that demand is not continuing to grow. There's a difference between demand and consumption if you go back to your economics courses in college. It's not that demand hasn't continued to grow. It has continued to grow. It's that natural gas prices last year were relatively low. It was a very low gas price year, and gas price essentially was on average around $2.90 per MMBTU last year. And this year it's been well over $3 per MMBTU on average. So what we had last year was a lot of coal to gas switching. In other words, the marginal coal units with the environmental externality costs considered for the coal units switched off, and gas units came on in place of them. And so that's why we had essentially in 2012 a pretty good surge in gas-fired power generation, and thus a surge in gas use in the power sector. And what you're seeing this year is a moderation back on the amount of gas used in the power sector as we get gas switching back to coal. In other words, the gas units are turning off as the gas prices have risen relative to the coal prices, and the coal units are coming back online. RCI gas use, residential, commercial, industrial gas use, is rising. And what we're seeing is a resurgence in the United States right now of an interest of using relatively low-cost natural gas molecules in the industrial sector in particular. And you can't pick up one of the trade press articles or trade press journals daily without seeing another new gas use source announced in the industrial sector. Basically, there's tremendous interest right now in using natural gas for petrochemical applications. You have ammonia production, ethylene production, polypropylene production, propane exports. You see a lot of these projects cropping up in the press almost daily. There's tremendous interest at the relatively low gas prices that we have to use incremental molecules in natural gas and natural gas liquids. On the flip side, if you look at the U.S. production numbers, production has continued to increase, as I pointed out on the previous slide, and we expect the production will continue to increase going forward pretty significantly. Now, if you look at imports in import-export activity, Mexican exports, net Mexican exports are actually up from the U.S. That's for incremental gas use in power plants along the U.S.-Mexican border. And then net Canadian imports to the U.S. are actually down pretty significantly, and that's because we are continuing to see a weakening supply and growing demand in Canada that's essentially soaking up the molecules in Canada and making it less available, making natural gas less available for export to the United States. Now, I'd be remiss if I didn't talk about storage. Storage is one of the numbers that I think that analysts look at pretty regularly. The EIA issues the storage report weekly and then updates the numbers on a monthly basis. And what we've seen in the last year is that the storage levels came out of the winter of 2011 and 12 at a very high working gas level. But then as we went through 2012 and then we saw a more normal winter this past winter, 2012 and 13, the storage levels moderated. And they moved back toward their 5-year average. And essentially this year, the storage levels have been much closer to the 5-year average throughout the course of the year. Thus, that's part of the reason for the firming of natural gas prices. because storage is a measure of how tight the supply-demand, or at least it's an indicator of how tight the supply-demand balance is for natural gas. And because the storage levels have moved back toward a 5-year average, in other words, they're less robust than they were last year, that's an indicator that the supply-demand balance is a little bit tighter this year than it was last year, and that's why gas prices have firmed over the past 12 months. And in fact, this chart shows historical gas prices. You can see that back in 2012, the level was pretty low. It was earlier in the year, it was back in the $2.50 per MMBTU ballpark. At Henry Hub, it fell to a low in March of about $2 per MMBTU, and then crept back up throughout the year. And currently, gas prices are sitting at about $3.50 to $3.70 per MMBTU at Henry Hub. They're in that ballpark. And we project that the gas prices are going to be in about the $3.50 to $4 per MMBTU ballpark over the next 12 to 24 months. We perhaps have a little bit more seasonality in our projection than the futures markets suggest here. And what I'm showing is a comparison of our projection, fundamentals model projection against the futures market projection in the near term. We're essentially saying the price is going to be about $4, $3.50 to $4. That's in line with the futures market, but we have a little bit better seasonality and think that as we see a cold winter, or if we see a relatively cold winter, then certainly we would see some pressure on prices this winter, albeit gas prices aren't going to get back anytime soon to where they were back in the prior decade, which was much higher than levels you see on this chart. Now, I should also add as well, we assume normal weather going forward, so that seasonality is on the basis of a normal winter. Of course, NOAA's projection this morning, I think, was for a little bit warmer than normal winter, so that would mean that you would expect to see less seasonal volatility or less seasonal price spread in the projection, at least for this winter, and thus a little bit lower prices in the winter. Now, the other thing that I should point out, too, is what does this mean for residential and commercial consumers who buy gas from gas utilities? It means that the gas prices are going to be a little bit higher this winter versus last winter. If you think about the way gas utilities buy gas, they buy it over the course of a year. So what they're selling essentially to a consumer in the winter is a basket of that gas that's purchased over the course of a year. And gas bills, of course, reflect the commodity charge for the gas, and they reflect the transportation and distribution charges as well. So a good portion of the bill is a fixed, if you view it that way, that's perhaps not the right terminology to use, but it's a fixed cost component with the distribution and transportation charge, with the commodity being the portion of the bill that moves with gas prices. So only a third of the bill, or 40% of the bill, will move with the commodity prices for a residential commercial consumer. But nevertheless, the average gas price last year was about 30% below this year's price on average. So that would seem to suggest that, gas bills this winter for residential commercial consumers will be about 10% higher this winter, given a normal winter, and thus consumption levels over the course of the winter that are consistent with last winter, relatively consistent with last winter. Last winter was pretty normal. So that would suggest the bills would be about 10% higher this winter. And that is certainly consistent with the numbers that we heard from Adam this morning. Now, this chart shows very interestingly that gas prices are a function of weather. The commodity prices can swing pretty dramatically as a function of weather. And what I'm showing here is a rather interesting application where what we do is we take our base case, which assumes normal winter weather, and whenever we run it through our model, we can run it with different weather scenarios. And so what we're doing is essentially running about 80 years of different weather scenarios through the model, 80 years of history here, and we're showing you the distribution on gas prices at Henry Hub that result over the next 12 months. In other words, a 12-month strip, if you will, that will result with all those different weather cases. So quite a lot of variability just due to weather. At the low end, we could see gas prices down, $3 to $3.50 per MMBTU. That's certainly the observations there on the far left of the chart. And at the high end, we could see commodity prices on up in the $5 per MMBTU ballpark on average, we expect the prices to be about $4 per MMBTU over the next year. And that would be something consistent with the normal weather that we're assuming in our base case. So a lot of distribution, and the distribution is also asymmetric. It's not necessarily a normal distribution, which means that the risk for higher prices due to, let's say, a much colder than normal winter or a hotter summer than normal is for prices to be much greater due to those scenarios than it is for milder weather scenarios. Okay? Now, that's kind of the short term. It kind of says prices, we expect prices to be about $4 per MMBTU. We expect the gas balance to tighten some in the short term, and watch certain signposts like weather because they cause a lot of variability in prices. What about the longer term? Well, whenever you talk about longer term prices, you get into a couple of different questions. First question is, what does the supply look like, or what does the resource base look like for natural gas going forward? The second question is, what does the market look like, or what does the market growth look like? Well, so let's put the market and market growth question aside for a second. Let's focus on the resource base. There's a lot of information on this chart, and I think many of you have seen me present the resource base information before in prior conferences, prior NASIO meetings. But suffice it to say, with all the numbers and all the detail on the far left in that table, there's lots of gas resource out there, lots of gas molecules. Basically, 4,000 trillion cubic feet of gas that is economically viable to be developed in the future. And you know, 4,000 trillion cubic feet, your logical question is, well, what does that mean? I don't know what 4,000 trillion cubic feet means. What does that mean? Well, that means putting that in perspective compared to what we consume in the US and Canada today. We consume roughly 28 trillion cubic feet per year. That's about 150 years of production, 140 to 150 years of future production. So big numbers. The shale gas resource base is the biggest portion of the resource by far. It roughly accounts for about half the resource base. I think the chart, the map here on the chart on the bottom right here is pretty enlightening as well. What that's showing is the cost of developing that resource base. And that is an all-in cost. It includes a cost of capital. It includes the capital investment to it with a reasonable rate of return applied. And what it is essentially showing, it also includes variable and O&M costs. What it is essentially showing is that at $5 per MMBTU, in other words, an all-in cost for gas of $5 at Henry Hub, that you would see roughly 1,500 trillion cubic feet that's economically viable at that level. Now, putting that in perspective, that's about 50 to 60 years of resource that's economically viable at $5 per MMBTU to meet demand over time. So suffice it to say, gas resource is not likely to be the constraining factor on gas markets going forward. I could see maybe environmental issues playing, fracturing policy, for instance, regulations on fracturing, things of that nature playing a bigger factor, but not necessarily the resource base itself. And certainly with this larger resource base, it portends well for future production. And what I show here is ICF's longer term projections for natural gas production in the US and Canada. The chart on the top left shows essentially what the production is by the major components of production. In other words, shale resource versus the non-shale resources. And it shows that we see production rising from roughly that 28, 29 trillion cubic foot per year ballpark value that we're currently at on up to roughly 40 trillion cubic foot per year by 2035. And certainly the growth is rather dramatic over time and over some periods of time, but it's by and large the growth is coming from shale gas resources, shale resources in general, not just gas resources, but other shale resources, including the oil and liquids resources as well, where there's associated gas production along with the liquids. On the flip side, the conventional sources of supply decline in our projection, and this is certainly consistent with what a lot of analysts are saying about gas production going forward. Now, I think the chart on the bottom right is maybe perhaps a little bit more enlightening because it shows regionally or from what basins the shale gas increases or shale resource increases are coming from over time. And some of these numbers are eye-popping. The units on this chart are billion cubic feet per day. I've kind of switched units between the two charts, sorry about that. But billion cubic feet per day. And one of the areas that you should really look at and focus on is the Marcellus itself, for instance. The Marcellus Shale, everyone now knows about it. It's big basin, northeast United States. And it's currently sitting at upwards of 10 billion cubic feet per day. Putting that in perspective, that's about 15% of U.S. and Canada gas production. So it's grown from essentially nothing in the year 2007 to 15% of the U.S. and Canada gas production over a very short span of time. And we project that it's going to grow up to upwards of 20 billion cubic feet per day. So it is a game changer for North American markets and certainly changing the face of the markets and the transport dynamics across the markets throughout North America, and that has a lot of implications for everyone. So the supply is going to be there, but what about the market? Where's the market going to come from? Well, you know, a lot of people widely think that we're going to see growth in continued growth in gas-fired power generation consistent with what we've seen over the past 10 or 15 years. I agree with that assessment. I think we're going to continue to see growth there. It's going to come from electric load growth, which will continue to grow. It's going to come from coal plant retirements, which we project about 60 gigawatts of coal plant retirements in the U.S. and Canada. And it's going to come from the nuclear fleet continuing to have issues and problems. Certainly over the past year, we've seen the SONGS units in California announce retirements. We've seen Crystal River in Florida have some problems. We've seen a couple Northeast units announce retirements. So the nuclear fleet is clearly aging and having some issues. So we see gas use growing in the power sector. Now that's along with renewables generation. But there's also these other uses for natural gas that we think will increase. There's petrochem increases in natural gas use. We think they could be pretty significant. That again is ammonia production, ethylene production, polypropylene production, as I mentioned earlier. You get into the wild card uses for natural gas, like what about natural gas in vehicles? We see a lot of states with programs now to motivate natural gas use in vehicles. What about GTLs, gas to liquids, which is really natural gas use in vehicles? It's gas being used to being converted to diesel. We see that there's also an opportunity there, and our oil price projection is around $100 per barrel in real terms going forward. So at oil prices of $100 per barrel, it's pretty attractive to use natural gas at $5 per MMBTU. Certainly the economic arbitrage opportunity is there, and the question is, will the market come to grips with the big capital investment that's required on the GTL facilities, for instance? What about LNG exports? Well, we think that LNG exports are going to occur. Matter of fact, we project 4 or 5 facilities in the U.S. in our projection, and another 3 or 4 facilities in Western Canada in our projection. Certainly, again, with global LNG prices where they are, which is by and large linked to oil prices in a number of markets around the globe, it's economically attractive for the U.S. to be exporting LNG, economically attractive to the U.S. producers, and economically attractive to consumers abroad. And then finally, Mexican exports, we continue to see that they will increase as well. So there's our market side projection. We have tremendous growth in the market. It's coming from all these sources, as I alluded to. There's roughly 9 BCFD of growth in LNG exports, 2 to 3 BCFD of growth in GTL facilities. We assume 2 GTL facilities in our projection. There's an incremental 2 to 3 BCFD growth of petrochemical load growth in natural gas. And then there's additionally the Mexican exports which have about 2 to 3 BCFD of incremental growth as well. So between the period from 2014 through 2021 or 22, we see roughly 20 billion cubic feet per day of incremental growth in natural gas load. It's a pretty significant value if you think about it. And I can't recall a time in recent history, certainly if I look back over the last 20, 30 years, when natural gas load has grown that significantly over a relatively short period of time. Now, I would be remiss if I didn't mention midstream infrastructure. Midstream infrastructure is important because it kind of ties the molecules from the wells to the end user. And suffice it to say, there's a lot of information on this slide, but basically what this information says that there's issues in spades across the midstream infrastructure development space. There's shifting dynamics on the utilization of natural gas infrastructure that has cost recovery implications for the providers of that transportation infrastructure. There's gas to oil conversions that are occurring in the midstream space. In other words, gas pipelines being converted to oil pipelines. Because not only is natural gas production growing significantly, but oil and natural gas liquids production is also growing pretty significantly. There's oil and NGL infrastructure that's needed to accommodate that increasing production. There's additional processing and fractionation capacity that's needed for the liquids, the natural gas liquids. There's additional oil and NGL pipelines that are needed to, again, move the molecules, in the case of oil, to refineries and move the liquids to different facilities that will use the liquids, like ethylene production and polypropylene production facilities. Then there's the Alberta oil sands issue. Alberta oil sands are growing pretty significantly. There's a lot of transportation infrastructure needed for the Alberta oil sands. There's diluent that's needed to lighten up the oil so that it can be transported. So there's natural gas liquids being transported back into the oil sands to be used as diluent to lighten up the oil. And finally, if you look at the petroleum complex, there's issues there with the refineries. Refinery upgrades may be needed to handle the different grades of crude coming into the refineries, because generally a lot of the unconventional shale resource is lighter crude than the heavier crude that's been historically produced. And one final point I would like to make, and then I'll entertain questions, is that, of course, a lot of this is very uncertain. And whenever I, the analyst, think about this, I try and think in multiple direct dimensions about uncertainties, and that there's very different scenarios that can occur over time. And this chart kind of depicts one way you could think of it, which is that one of your measures for an alternate scenario could be oil gas price environment. You could have a relatively high oil gas price environment. Certainly that's where I think we are right now. We're in a relatively high oil gas price environment. Or you could have, on the flip side, a relatively low environment where oil prices moderate some and gas prices firm some. You could also have a very different investment environment, something that is maybe encouraging gas use or something that's discouraging gas use. And that gets into policy issues, regulatory issues, things of that nature, and what the economy looks like and whether capital is relatively free-flowing. All of those criteria create very different scenarios and environments going forward, and that's what makes an energy forecaster's life like mine very interesting, because everything's always changing, and so you get an idea as to some of the different scenarios I think about going forward, which is, what will LNG exports look like? A lot of uncertainty there. Policy drives it, but certainly the oil gas price spreads drive it. What about petrochemical gas use? Again, policy, regulatory framework can have an influence there. Oil gas price spread definitely drives petrochem's gas use going forward. What about supply development? Will we have regulations on fracturing? What will they look like going forward? And how freely will capital flow if the regulations are factoring in? All those things play in the future environments going forward. And then one last point, then I will get to questions, which is, whenever you think, I've strictly talked mostly about the national markets and what the national markets look like. You also have to think in terms of regional markets. Regional markets can look very different than the nation as a whole. And one of the regions, and I won't talk much about this because Eric's going to be talking this afternoon from ISO New England, but one of the regions that can look very different from the nation as a whole is New England. We're projecting relatively low, moderate gas prices going forward, pretty strong supply compared to demand. New England, on the flip side, is a very constrained market in the wintertime, in particular on cold winter days. And why is that? Well, it's because the pipeline capacity is highly utilized, and the swing capability for right now for New England is essentially the LNG imports. LNG imports at Everett and LNG imports that come in at Canaport and then are transported down on M&N. That's essentially the swing supplies for New England here in the near term. So the point being, whenever you look at national markets, don't think that all the regions will necessarily look the same as the national markets. You have to really look pretty hard at the regional dynamics. And with that, I'll be happy to answer any questions. Talkative group. Okay. I don't think I've never had a conference where I didn't have a question, but very good. Thank you very much.